Very happy Friday to you. Happy Labor Day in advance, and welcome to our next edition of the Elville webinar series. I'm Jeff Stauffer, Community Relations Director with Elville & Associates, and I'll be your moderator for today. And our topic today is Planning for the Future Using Real Estate as a Vehicle, presented by Marie Ritzenberg, Mortgage Advisor with Main Street Home Loans. And this is our third presentation in a series with Marie on Main Street, and we really appreciate their partnership and the really great education that Maria shared with our staff and you over the past several months. So as always, we encourage your general questions, so please note them in the chat or the questions section on your screen, and we will pause periodically throughout to address them. And your questions always add great value to the presentation, so don't be shy. This morning by email, you also received the presentation slides that Marie will be referencing, and these slides are also available in the section marked handouts on your screen to download at this time. We also have some professionals on today's presentation. Welcome as well, and thanks for being here. 1.5 continuing education hours are available for most everyone in attendance. Now, if I don't have your ID number or an accreditation that you'd like me to use, please send that over to me so I can send CE outs by the end of today. And everyone will also receive a post-webinar feedback email right after the presentation. So please take just a couple minutes to fill out this brief survey and offer us your feedback about the presentation. And we read and appreciate every comment you have to share with us. Here at Elville & Associates, we always are here as a resource for your family and you. If you are new to estate planning, have new needs to address, or old documents to update, which is definitely not out of the ordinary, or even another matter, Steve Elville and his team are here to advise and counsel you every step of the way through those processes. So Marie has a great deal of information to share today. Please reach out to her afterwards to discuss your specific situation with her. She'll be very happy to be a resource to you. And I'll turn it over to Marie. Marie, many thanks for being here. Hope you have a great Labor Day in advance, and always appreciate your time and the great information that you have.
Thank you for having me. I appreciate it. Thanks for joining us, everyone. Today, we're going to be discussing the main topic of using real estate to plan for the future and use that as a vehicle to help advance retirement. As we go along, as you well know, your team here at Elville are the ones that had kindly invited you guys, so please reach out to them regarding your elder law needs, estate planning, trust needs, and that's something I'm stressing to my clients as well. Consider putting your real estate in a trust. So that's always something we reinforce in our industry as well. My name is Marie Ritzenberg. I am a loan officer with Main Street Home Loans. I've been in the mortgage industry now for 21 years, have enjoyed servicing clients and helping them with their mortgage financing needs, whether it's a first-time buyer, move up, downsize, building a real estate portfolio of investment properties, that vacation home down at the beach or the lake. So really, I just love helping people and accomplish their goals. Main Street Home Loans, we are a national lender. I personally am licensed in 7 states, but our company is licensed in 49 states currently. So I'm happy to help for the most part on the East Coast, Maryland, and south down to Florida. And wherever I can't help, I have a teammate that can. So today's topics, thinking about real estate and helping accelerate your retirement. So considering locations where you may want to go long-term, thinking about maybe getting into those long-term locations sooner than later, getting introduced to real estate investing, building the portfolio, and of course, long-term wealth. So in regards to real estate has always been, the American dream, but also has been a way for clients to, and homeowners to build generational wealth. Sure, the market has ebbed and flowed. We've seen that with interest rates, with home values, with the stock market, but things all show that generational wealth is built mainly on the foundation of real estate. So we're going to go into some details to look at history and trends regarding the real estate market. And we're also going to discuss the types of properties as well, whether it's single family, multi-unit, second home, rental, or investment properties. So looking at, why real estate? Since we have professionals on the call, we all know tax benefits, building that equity, and having real estate as the long-term investment. We are seeing investors purchasing real estate and using that for a short-term investment, like wholesaling or flipping, and we'll discuss that in a moment as well. But when you look at where the history has been with home price index and stock price index, this is a little dated, ending in 22, but you can see that real estate has been rather steady. We don't see the spikes that we may have seen in the stock market. So overall, a great long-term investment. It's interesting when I speak to clients and educate them, especially the first-time homebuyers, they don't even realize their tax benefits that they can take advantage of. So once they receive that education, it makes so much more sense. And then they can get into a property and take advantage of those opportunities and make their income grow faster. The power of real estate, when we look at, this is a little outdated as well, but when we look at where real estate versus treasury bonds, equities, treasury bills have been, you can see that housing has always been steady. We've seen, the market ebb and flow, but certainly these numbers prove that real estate is always a win. In regards to interest rates, that's always a question. We are luckily seeing interest rates begin to decrease. Very exciting. We're likely not going to see interest rates go to where they were in 2020 and 21, but the history of the 30-year mortgage, you can see, back in the 70s, almost 8-9%, 80s, 12-13%. I remember speaking to clients where they were excited that they were able to assume a VA loan at 13%, or tickled that they were able to get an 11% rate back in the 80s. Rates have continued to decline. So we're right now, today, depending on the client's circumstance, what is the occupancy, credit score, down payment, all of those factors will play into the interest rate that someone receives on a mortgage. But I would say average interest rates are in the 6s right now. Certain loan products that offer unique qualifications may have a slightly higher interest rate because of that convenience factor, but average rates around 6 today. So that's exciting because I've got clients that purchased in the past year, 2 years where rates were almost at 8. So we are starting to see a refinance opportunity come about. In addition, we're expected to see real estate continue to rise in values. There is so much land that is available to build. So we are seeing a lot of smart growth where it's mixed use properties, commercial on the first floor, residential on the second floor, et cetera. So we're seeing that commercial real estate is growing here as we see, but residential is steady and we're expecting appreciation to rise on average about 5% annually. So that's exciting. So how do you start? If you don't own any investment properties or a second home, if you are looking to build that portfolio, let's say you have a primary residence, hopefully, if not, we can always look at first-time homebuyer opportunities, but you've got to assess your financial readiness. Do I have the ability to invest into a down payment? Where are the funds coming from? We're also going to look at the right type of properties and locations for investing. And the loan types and the mortgage opportunities that someone would be eligible for, including the down payment threshold, the affiliated interest rate, a lot of that has to start with the occupancy, whether it's going to be a primary residence that someone would occupy within 60 days of closing. If it's a second home, like a vacation home, the guideline there is that you only have to occupy that property 2 weeks out of the year. So think about that. Could you purchase the property down at the beach or the lake, commit to a total of 2 weeks, not consecutive, but maybe, spring break or several weekends throughout the year to compile those 2 weeks total? That would equate to the second home guideline. What you choose to do the rest of the 50 weeks of the year is up to you. So that is the guideline, 2 weeks out of the year. Investment property, your goal is to not occupy at all. Your intent is to rent it out and never to occupy that property yourself. So those key factors will help determine what the loan to value threshold will be, and we'll get to that in just a moment. All right, so as we're getting started here, assessing your portfolio, are you ready? Where are your current investments held? Are they in stock, savings, high yield interest savings, checking? What type of tax shelter does someone have? Do they have a retirement account? So looking at those, it's always great to review this with your tax advisor as well, just to see, hey, do I have the tax shelter that I need or should have? And many CPAs and certified financial planners oftentimes say, hey, you need to invest in real estate because that's going to help your overall portfolio. Other things to consider: disposable income. How much is going into the bank for savings, or where are we utilizing our extra income that's not being spent? Perhaps considering investing that income into that portfolio and creating that generational wealth. So those are all things to initially consider. Do I have the bandwidth to take this on? So, we want to identify the right properties, and one key place is start at home. If you own a primary residence and you're not utilizing your full property, perhaps could you consider renting out the basement? There are many individuals that utilize house hacking to get started. Let's say someone's mortgage payment is $2,500 a month, and they could rent out their basement and gain $1,000 in monthly rent. Now they're only paying $1,500. So they could utilize those extra funds to help them pay their mortgage down faster. So instead of paying the $2,500, maybe they're paying $3,500 because they're getting this extra $1,000 in rent from their tenant. Or perhaps that could be utilized towards a savings pattern to complete the down payment for the next property. So there are different ways that you can look at house hacking, as we say in the industry, and utilize what you currently have, especially if it's not utilized to its best capacity. Other things to think of with location: can I purchase this retirement home now? Many people can work remote. I've got clients that actually just closed on Tuesday, and they were living here in Howard County, and their goals shifted where they can work fully remote. They didn't need certain aspects of where they were living now, as opposed to when they initially purchased the home years ago. So knowing that they wanted to move to the beach, buy in Delaware, we had the discussion on, well, let's get this, long-term goal started now. They closed on a new construction property on Tuesday, and they can work remote. They're at the beach. They're now able to live that retirement lifestyle, and they're only in their 30s. So you have to think about that long-term goal, like, do I really have to be here physically for the school systems, for the being close to my family? Do I have to report into work physically? So those are questions that people would want to think about. But if you can work remote, all we need is a letter from HR that states this homeowner or my employee can work remote. Their income, their job title will all remain the same, whether they live here in Maryland or if they go to choose to live in North Carolina, for example. So it's really easy to get that documentation, especially for our remote clients. And coming off the heels of summer here too, maybe you want to retire where you vacation. Maybe you could buy that second home now, and instead of renting the property and paying that landlord or that Airbnb homeowner their fees to rent the property that you are enjoying vacationing at, perhaps consider buying your own rental property or your own vacation home, utilize that for your vacations, and then you can consider Airbnb that for the weeks that you're not utilizing that property. So make it the endless summer. Why make summer stop? All right, so with identifying properties, there's all different styles of homes, whether it's a single family home, that could include a townhome, row home. There's multi-units, so that's rather common and a rather interesting play when it comes to investing. And then there's, of course, condos, for example. I do want to harp on the multi-unit property. So multi-unit, if you're looking at up to a 4-unit property, you would want to occupy one as a primary residence, potentially, and you could rent out the other 3 properties. The unique idea with that is we can use the rental income from the other 3 units to help someone qualify for that multi-unit home. So, think about if you're a first-time homebuyer or have a client or a child that's looking to enter the real estate marketplace, for someone with, a rather new income or getting themselves established, it may be challenging to get, established in the real estate market. But if they were to consider a multi-unit, we can use that rental income on top of their additional income to help them qualify. And then when they are ready to move on from that multi-unit into the townhome or single family, they can then rent out that fourth unit. And now they have this fully income generating property of 4 units, 4 monthly rent checks coming in, and that can be utilized to help them qualify for the next property. So that's a really interesting play. And my 13-year-old knows that that's what he's going to do when it comes time for him to purchase a home. If I knew back then what I knew now, I love that we purchased a single family as our first home, but I wish that I had that knowledge base and started out with a multi-unit personally. So the occupancy plays into a lot of this too. So with the multi-unit, today, conventional financing only requires a 5% down payment if you're going to occupy one of those units as a primary residence. FHA financing is only 3.5% down. But if the occupancy is an investment property, then the down payment becomes greater than those minimum guidelines. We'll get to that in a moment as well. Other considerations when you're looking at the long-term goals of, where do I want to retire and get this process accelerated? Consider the areas that may not have income taxes or don't have retirement income tax. Obviously, other considerations would be where the taxes are lower, cost of living may be lower in certain areas as well. And of course, your appreciation factor and what's happening in that local economy and what the, lifestyle and culture of that local economy brings. All right, just looking to see if we have any questions. So stop me, Steve, when we do, or Jeff, excuse me, when we do. In regards to continuing that portfolio and occupancy and down payment. So with a primary residence, the minimum down payment for a conventional loan would be 3 to 5% down, 5% if it's a multi-unit. FHA is 3.5% down up to that 4-unit property. And then if someone's eligible for a VA loan, our veterans, our service members, and if the property and borrower are eligible for USDA financing, then those opportunities would allow for 100% financing, no money down. And these thresholds are all prior to any down payment assistance programs or grants that they may qualify for. We participate with a bunch nationally. There is a national grant where a primary resident could get as much as $15,000 towards down payment. We can funnel that down based upon their local needs, whether it's state funded, county funded, even perhaps city funded. So I'd always look to see what does the client qualify for. With second homes, second home requires a 10% down payment. So occupy that property for 2 weeks out of the year, only 10% down. And with an investment property, those down payment minimums begin at 15% down. The greater the down payment, the lower the interest rate, the less risk, specifically from an investment property perspective. Mortgage insurance would not be required when someone puts down 20%, and the interest rate continues to improve when we hit even 25% on an investment property. In regards to the closing costs on top of these down payments, they are on average about 4% of the price prior to the new changes with realtor commissions. So in certain cases, a buyer might need to pay for their realtor commission if the seller is not paying for the buyer's commissions. So we'd have to see closing costs, down payment, and does the buyer have to worry about paying any realtor commissions in that case. With investment properties, we always like to look at, programs and products that would suit someone's needs. Are they going to own the property short term, or would this be a long-term investment? If we're going to buy and hold, meaning buy and rent the property out, certain products would make more sense than if this were a short-term ownership, like fixing and flipping a property. If someone were to buy a property where it looks like it's distressed, buy low, do some renovations, and sell high, our standard products would not be the best bet for someone looking to purchase wholesale or fix and flip. we would want to look at perhaps utilizing alternative methods like home equity line of credit or even hard money loans as well. So there's always some avenue that would work for a client's needs. It's just what's the long-term versus short-term investment goal. We've got to look for that profit margin. Are they looking for the immediate equity where they can buy low, do those reno and sell high? We're seeing a lot of that in specific locations here in Maryland. And we also have to look at long-term equity and their potential profit margin on rental income. So when we look at investment, is it I'm going to rent it out long-term versus fix and flip? Financing. So mortgage financing, it's only so exciting, you know, but certain aspects really can be exciting to discuss. So there's different ways we can utilize and leverage someone's financing. Are we leveraging the equity in their home? Are we looking at alternative financing methods like DSCR? We'll talk about that too. So mortgage financing types, we can look at the traditional mortgage, where we look at their income, assets, debt load, see what they qualify for. If it is a rental property, we can use 75% of the fair market rent for that new property to help qualify. That would be including all of the docs. I joke around, you know, income, asset docs, everything but a blood sample and the firstborn's footprint, because we're getting all of that documentation. There are other loan programs that someone may want to choose rather than the traditional qual, like a bank statement loan for someone that's self-employed. That's very popular in today's market. Or also very common is the DSCR, debt service coverage ratio, specifically for an investment property, where we do not get into the borrower's income or income documents at all. We do get asset docs to see where the down payment's coming from, but we don't get the tax returns, W-2s, pay stubs. We look at what income the property will generate. So that's very unique. So when we order the appraisal to confirm what the fair market rent is, or what the value is, we also order a rent schedule for fair market rent. So if the new mortgage payment for that property is $1,800 a month, we ideally want to confirm that fair market rent is $1,800 or greater. And that just shows us that the property is self-sufficient, that the rent you collect for that property will pay for the mortgage itself. That's very popular nowadays. And I actually am refinancing a lot of investors out of their hard money loans into this DSCR product. So speaking of hard money, that basically is a very convenient product, very minimal documentation. Hard money is meant to be a short-term vehicle to acquire the real estate because it has a one-year balloon where the mortgage needs to be paid off usually within the first year. So that is a great product in certain circumstances, but that's not the long-term goal. Hard money is usually great for investors that are looking to fix and flip and get rid of that property or resell the property within a year. Moving back up a little bit, we can look at a home equity line of credit or a home equity loan against someone's real estate and utilize that equity in their current home towards the purchase of the new home. Up to 95% of the equity in the property could be utilized, assuming it's a primary residence. We do have some investors that will allow for a home equity loan on a second home and or even an investment property, but those loan to values are a bit lower, usually capped around 75 to 80%. In regards to being non-contingent, if you're looking to, let's say, relocate to the retirement area now, and perhaps want to be non-contingent upon the sale of your current home, we could utilize a bridge loan against your current property, have that towards the down payment of the new home. And once your current home sells, now you'll be paying that bridge loan off. So that helps someone refrain from liquidating their assets or their portfolio and pull the equity out of the home, use that towards the next purchase, get settled, then list their prior primary residence for sale. So that's been very popular in today's market as well. And lastly, we always could look at other ways like leveraging assets. Could we, leverage funds in a stock account or their portfolio? Perhaps if it's a primary residence that's being purchased, they could take a retirement loan against their 401k. Jeff, it looks like we might have a question perhaps.
Yes, we do have one. question is, to build generation wealth, have you had clients that fund down payments from a trust account?
That is something that they can do. We have to get the terms, so we'd have to, document where the funds are coming from. And normally we can see a statement that's generated from that trust account. They could leverage that, and we would get the terms just to show, what are the terms of those funds that are being utilized. If it's not formally being liquidated, there's no liquidation to prove, but we would show the current statement, then the new statement once the funds are leveraged, and utilize that towards the purchase. So that can be done. Perfect. Okay. Passive income streams, we certainly want to look at those ways to generate rental income. And in today's world, I've often heard investors look at doors or speak of doors. I have 40 doors or 70 doors, and it doesn't mean that they have 40 or 70 rental properties, single standing homes, but they oftentimes are utilizing those properties and renting out each room in the home. So if it's a 4-bedroom home, that one home is actually 4 doors. So that could be a long-term rental for each of those units or rooms in the property. They could be short-term, like the Airbnb. So those are different ways to look at things too. It doesn't always have to be, an annual lease. It could be the short-term lease or an Airbnb, depending on location, if that location allows it. We have seen some locations don't allow for short-term rentals. And then with the annual rental, we're used to seeing rent rise 5 to 10% each year, so that's something we can usually bank on. We also have to look at with the short-term rentals, is it allowed in the location, but also with your expenses. When you have the consistent turnover, how much are you spending in the cleaning and linens and refreshing the property for the next tenant, making sure that that profit margin makes sense. So when it comes to keeping and protecting your assets, I am a firm believer, and this is something that Elville and Associates specializes in, so I don't want to steal any thunder, but just a few little tidbits here. When we're planning the estate and leaving that legacy for our family with generational wealth, we've got to consider a few different things. So considering the power of a 1031 exchange, when someone is purchasing investment properties, selling, and then rolling those funds into the 1031 exchange, that can defer the capital gains taxes when they're purchasing another like-kind investment property. So with the 1031, it's a very powerful option where you work with a third party, you identify usually up to 3 properties, and there is a time frame usually of 60 to 90 days that you have to purchase the next property by. But that is a way to help protect your assets overall and pay less in taxes when you utilize this vehicle of the 1031 exchange specifically for investment properties. In regards to the trust, I find we all probably find it very important that the trust is imperative to help manage assets, tax benefits, potential of avoiding taxes, and of course, privacy and alleviating risk. Many clients and investors that I speak with, they think that an LLC may be a great option, which very well could be, but also when they compare the LLC versus the trust usually provides greater benefits overall. So whenever a client is purchasing a property, if they do not yet have a trust, I plant that seed and have that conversation on here's why, and it doesn't cost that much to get it started, but it's going to help protect you, your legacy in the long run. And building that portfolio, it's imperative to have that protection. We went through this pretty quickly, team. What questions do we have?
Maria, looks like we have another one here. Says, I have heard of a new mortgage where the future renovation value can be used initially for the appraisal when someone is looking to do a renovation. Is this realistic?
Yeah, actually it is. So we can utilize a renovation loan for either purchase or refinance of any of those occupancy types, whether it's a primary residence, second home, or investment property. So the way it works is, let's just give an example here. If the purchase price of the home is $400,000 and the renovations equate to $100,000 that are needed to complete the property. So your acquisition price would be the 400 plus the 100 for a total price or acquisition of 500,000. You would have to work with licensed and insured contractors to do that renovation work, just because we won't necessarily give someone $100,000 without seeing the scope and who they're going to be working with to fund this project. But when we order the appraisal, we have that work write-up or bid in hand. So when the appraiser goes out to the property and they see the home at its 400,000 value state that it's listed for, they'll check the property out, look at that renovation bid to see what will be done. And when the appraiser completes that appraisal report, they're looking at that after improved value. So they're saying, okay, based upon what this home will be turned into, like-kind properties in this area are worth this much. So yes, that is the exact way a renovation mortgage would work for purchase or refi, and it can be used on primary, second home, or investment property.
Okay. Great. So now would be a great time to get any final questions into Marie. There's some items I always try to send out afterwards that are hopefully helpful to you after our webinars. They include today's video link, the slides again from the presentation Marie shared. Also, I'll send out the links to Marie's other two presentations that she offered earlier this summer, which were also really great. And also, I'll send the link out from our YouTube channel. Did you know that every webinar we've ever offered is available on our YouTube channel? I think I look a lot younger in a few of them. But I think we have something like 293 presentations on there for your viewing pleasure. As far as our presentations coming up with our webinar series, on Wednesday, September 11th, we'll have Steve Elville back talking about learn what elder law attorneys are advising clients in 2024. On the 18th at 10, we'll be talking about guardianship and the alternatives, also with Steve. And then an evening presentation at 7 o'clock on Wednesday, the 25th of September, estate planning and elder law essentials. And that's in partnership with our good friends, Mark Timmick and Gail Timmick at Timmick Financial. It's a semi-annual 3-night series that we offer. And on Friday, the 27th, we'll be in person at the Howard County Public Library East Branch in Columbia. Again, talking about estate planning and elder law essentials with Steve. So please come out and see us, and we would love to see you in person at that presentation. Let's see if we have any final questions here for us. Okay, one question here, Marie. Can a long-term 1031 rental property be retitled to a revocable or irrevocable trust?
Long-term. So just to clarify, the way I'm understanding that is the property was acquired using the 1031 exchange, and now they're going to hold that property as a rental and put that titled in the name of the trust. That's why I understand the question. If I'm understanding it correctly, the answer is yes.
Okay. Great. If you have specific questions about like a specific situation that you're currently in or looking to move forward with, certainly reach out to Marie. Her contact information is there, and I'll send that out in the email. I'll have that out within the next hour or so. So Marie, thank you so much for your time today. Great information. And let's do it again. I think we've done 3. We'll keep moving forward with this. Great information. And I want to thank all of our attendees today for being here, and hope you have a really enjoyable labor-free Labor Day weekend.